Hello, dear students. Good morning. Myself, Professor S. B. Bhendigeri, Department of Economics, taking online classes for PUC first year commerce students. Dear students, in the last video lecture, we discussed about the industrial policy reforms and financial sector reforms. And today, let us have a discussion on the tax reforms. Tax reforms is also very much important for the sake of economic development. In 1991, when new economic policy introduced through economic reforms, it was very much important and necessary to take necessary actions in the tax policy. Earlier, there were faulty tax policies in India. To overcome those faulty tax policies, the government of India has decided to bring certain changes in the tax policies immediately after 1991. The tax reforms are concerned with the reforms in government's taxation and public expenditure policies. Whatever reforms are expected in the tax system, that reforms should be taken on the government taxation and public expenditure policy. Whatever government is imposing, what amount of tax is imposed by government on public, and what amount of expenditure is being taken. We have to have a lot of reforms. We have to bring a lot of changes in these two areas, that is government taxation policy and public expenditure policy. These two are the important two pillars of tax policy, and these two are also collectively known as fiscal policy of the government. The fiscal policy of the government consists of government taxation and public expenditure. What amount of revenue is collected from taxes, and what amount of expenditure is being taken. So, with this, we are able to understand what is the status of the tax policy, tax system in India. And right from beginning, right from independence, government revenue is always less than its public expenditure. It is because of taking long-term developmental activities in the economy and imposition of compulsible taxes, suitable taxes. Because of that, right from beginning, what happened? The government revenue is always less than its public expenditure. When we are disclosing our budget, yearly financial statement, in that we come to know that government revenue is always less than its public expenditure. These two policies are collectively known as fiscal policy. They may ask in the examination for 2 marks. What is fiscal policy? Fiscal policy is nothing but the reforms in government taxation and public expenditure policies, which are collectively known as fiscal policy. Okay. Now coming to the meaning of tax, we have to understand what is tax first. To know the tax reforms, we have to understand what is tax. Do you know what is tax? The tax is a compulsory payment to the government by the actual taxpayers. It's a compulsory payment to the government till last breathing of human being. Still last breathing of human being, each and every person have to pay taxes in one or other reasons. Okay, so it is a compulsory payment to the government by the actual taxpayers, I said. Means those who are able to pay tax, those who are coming under the tax policy, those who are coming under the tax system, they have to pay the taxes to the government. The person who is not coming under paying taxes, he is not supposed to pay any tax to the government. So that is called as tax. Tax has two important types. Out of it, first one is direct tax, second one is indirect tax. Now look at the direct tax. What is the meaning of direct tax? These taxes consists of taxes on incomes of individuals as well as profits of business enterprises. Listen to me very carefully. Direct tax is a tax which is imposing on incomes of an individuals. Okay, incomes of individuals as well as profits of business enterprises. It may call as income tax. Whatever amount of income earned by an individual, based on the structure of tax, each individual should pay that amount of taxes to the government on his income. Suppose, for example, government is deciding the slabs of the tax, the slabs of the income tax, for example. If a person is earning, for example, suppose 3 lakh rupees per year, he is to pay, for example, 10% tax on that particular income. Okay. If a person is earning more than 5 lakh rupees tax, he is to pay, suppose, for example, 20% tax to the government. Like that, based on his income, he is to pay income tax to the government, that is called as direct tax. Even the profit of business also comes under the direct taxes. Whatever amount of profit earned by business enterprises and business magnates, they also pay tax to the government. That is also comes under the calculation of direct tax. Now coming to the indirect tax. These are the taxes which are levied on commodities and services. Okay, direct taxes are levied on incomes of individuals and profits of business enterprises, but indirect tax is levied on goods and services. Okay, whatever goods and services we are purchasing in the market, on that particular price we have to pay taxes to the government. Say, for example, if you are purchasing a soap or toothpaste, if the price of soap is 10 rupees, we have to pay 12 rupees for that. If the manufacturing price or actual price of soap is 10 rupees, in addition to that, if we are paying 12 rupees, for example, that additional 2 rupees is called as indirect tax. We have to pay it to the government. Okay. So, indirect taxes are the taxes which are levied on commodities and services. Suppose, take the example of services. If we are taking the service of, for example, flight, or else, for example, ocean transport, or else if we are going to movie, for example, so in case of movies we have to pay entertainment tax. Okay. In case of air transport we have to pay additional luxury taxes on that particular aspect. So these are the taxes on services what we are getting from government. Especially now these indirect taxes are merged in goods and service taxes, that is GST, which was implemented in the year 2016. So GST replaced indirect taxes system in India. Okay. Now coming to the next reforms which has been taken immediately after 1991, that is foreign exchange reforms. This reforms is very much important in case of international trade, in case of receipts and payments, in case of exports and imports, for example. So foreign exchange reforms is the first systematic attempt made on the external sector reforms was in the foreign exchange market in 1991. Okay. The first systematic attempt made on the external sector reforms was in the foreign exchange market in 1991. Foreign exchange reforms is nothing but reforms in external sector. External sector in the sense when we are having international interrelations with other countries in case of trade and commerce, that is nothing but, for example, external sector. Foreign exchange is a very much important topic to understand, and the students of commerce like you have to understand in detail about this particular topic, that is foreign exchange. It is an immediate measure to resolve the balance of payments crisis. Foreign exchange reforms is an immediate measure to resolve the balance of payments crisis. If whatever problems arise in the BOP, if crises are arise in balance of payments position, that can be solved only with the help of bringing balance in foreign exchange. Okay, I hope you understood. India devalued her currency on 1st and 3rd July 1991. To bring balance in balance of payments position, what India does? India devalued her currency on 1st and 3rd July 1991. What happens if India devalued her currency? I'll tell you. Okay. To increase the inflow of foreign exchange, India devalued her currency 2 times in 1991, that is on 1st and 3rd July 1991. The exchange rates depends on the demand and supply of foreign exchange. Okay. To understand this particular paragraph, you have to understand what is the meaning of foreign exchange first. Do you know what is the meaning of foreign exchange? Foreign exchange is nothing but the money in terms of foreign currencies. Whatever amount of money is held with government, that amount of money which is in terms of foreign currencies, that is called as foreign exchange. Okay. Suppose, for example, India is having some dollars and pounds and yens and, for example, currencies of different countries. What amount of currencies of different countries are there with India? That is called as foreign exchange. Okay. I hope you understood. It means the money in terms of foreign currencies. How much foreign currencies we have? That is called as foreign exchange. You know why? We need to have huge amount of foreign currencies. We need to collect, we need to have huge amount of foreign currencies. For what? To increase the international trade activities, we need to have this type of currencies. You know why? Whenever we are having international trade relations with other countries, the international payments are to be done only with the help of either the US dollars or else in gold, for example, form. Okay. Each and every countries are expecting their payments either in the form of US dollar or else in the form of gold, for example. Because of that, we need to have huge amount of foreign currencies. If we don't have sufficient amount of gold with us, to replace that, we have to have huge amount of foreign currencies to encourage international trade, for example. So international trade will be encouraged. It will be increased only when we have sufficient amount of foreign currencies. Okay. It is all about the meaning of foreign exchange. Now coming to the meaning of balance of payments. The term balance of payment explains the difference between exports and imports of visible and invisible goods and services. Try to understand. BOP, balance of payments, explains the difference between exports and imports of visible and invisible goods and services. What it explains? It deals with what amount of exports are taken place and what amount of imports have been taken place. Out of these exports and imports, how much visible goods are exported and imported, and how much invisible services are exported and imported. Balance of payments includes both visible and invisible items. Visible means physical goods, invisible items means services like hotel management, for example, uh, traveling supposed to be, okay, and communication supposed to be, okay, technology. So these are the examples of invisible services. But when we are looking at BOT, balance of trade explains only the difference between exports and imports of visible items. It does not include invisible services. But when it comes to BOP, it explains the difference between both exports and imports of visible and invisible items. So, when we are coming to know the difference between these two, it is easily understanding, we are able to understand what is the status of the country in case of foreign exchange, for example. Okay, if the exports are more than imports, BOP is in the position of surplus. If the exports are less than its imports, BOP position will be deficit. If the exports are equal to its, for example, imports, the BOP position will be balanced. Okay, so based on the difference between exports and imports, the country's economic growth can be calculated. Now coming to the next important aspect, that is meaning of devaluation. This is very important to understand the foreign exchange reforms. Devaluation means the deliberate reduction in the value of domestic currency in the external market. Try to understand very systematically. Deliberate reduction in the value of domestic currency in the external market. It means what? When we are depreciating the value of our currency, there is an increase in the demand for our goods in the external market. Okay. When we are reducing the value of our own rupee in the external market, when we are depreciating the value of currency, the demand for our own goods in the foreign market, what happens? Increasing. Do you know why? When you are depreciating your currency, automatically foreigners can pay less amount of money to purchase more goods and services. Okay. When you are paying less amount to purchase more, automatically demand for goods, what happens? Increasing. So immediately after independence and after 1991, what India planned? To maximize the exports. If you are going to maximize the exports, that is also depends upon the demand for exportable goods. How to increase the demand for exportable goods? Demand for exportable goods increases only when you are depreciating your own currency in the foreign market. So that is called as devaluation. Dear students, I hope you understood. This is all about the foreign exchange reforms. Now coming to the trade and investment policy reforms. It is also equally important in case of economic reforms. When India introduced new economic policy 1991, the further step is being taken by Government of India to bring sudden changes in case of trade and investment policy, for example, to increase the international competitiveness of industrial production and to increase the flow of foreign investment and technology into the economy, and also to promote efficiency of the local industries and to adopt modern technology, liberalization of trade and investment regime initiated in India. Okay, it is very interesting. I'll tell you the heart of this particular policy. Trade and investment policy means how to encourage trade and how to invite foreign investment into Indian industries, for example. It is the most important area of reforms in India immediately after independence and, For example, economic reforms 1991. You know why? Especially India is a labor-oriented country and capital is always lacking in Indian industries. To promote capital investment and to increase trade activities, it is very much necessary to invite foreign invest- investors, for example. Okay, when the foreign investors are investing their capital in India, when you are liberalizing the things, when you are making things very easy, if there are past and hard and, for example, difficult rules, okay, if there are complex rules and regulations, if there is a rigidity in the rules and regulations or else, for example, restrictions, no investor from other countries are coming forward to invest their capital in Indian industries. Okay, so we will have to liberalize the trade and investment regime. Then only there is a possibility of flow of foreign investment and technology into the economy. For example, when we are giving freedom to foreign investors to invest huge amount of money in Indian industries, they are taking initiation to invest in different industrial sectors, for example. Okay, so with this, the local industries are also increasing their efficiency, and the local industries can also adopt the modern technology of foreign countries. So, we may hit two birds by a single stone when we are bringing drastic changes in the trade and investment policy reforms. Hitting two birds with a single stone in the sense, if we are liberalizing the trade and investment policies, on one side we can invite foreign investors, and on other side the local industries can adopt the modern technology of foreigners. So, in a two-way profit we can enjoy when we are bringing changes in the trade and investment policy reforms. What happened before 1991? In order to protect domestic industries and controlling imports, India followed a regime of quantitative restrictions on imports by keeping tariffs very high. What was happened in pre-90s? In the pre-1991, India's exports and imports tariffs were very high. Due to that, India's international trade was completely restricted, and it was controlled imports to protect what? Domestic industries. To protect the domestic industries, if you are controlling imports by imposition of heavy tariffs and quotas on importable items, it is not a good sign of economic development. If we are controlling a particular activity, that is not good for either side. If we are managing it in a very systematic manner, we can expect greater, for example, heights in case of economic growth and development of the country. Okay. Now look at the aims of trade policy reforms. What were the aims of trade policy reforms of 1991? The first aim of trade policy was dismantling of quantitative restrictions on imports and exports. It means what? Whatever quantitative restrictions were there before 1991, we have to remove all those restrictions on imports and exports, and making the entire economy liberalization. When the entire economy is liberalized, liberalization means giving greater freedom to everyone. When everyone gets freedom to take their own independent decisions, automatically economic growth and development takes place in the country, for example. Coming to second one, that is reduction of tariff rates. Earlier in pre-1991, what I said in the beginning, tariffs were very high. Because of what? To protect domestic industries and controlling imports, Government of India imposed heavy tariffs and quotas on importable items. But after 1991, in trade and investment policy reforms, what Government of India has done? It has reduced the tariff rates, for example. Okay. Coming to the third important aim of trade policy reform, that is removal of licensing system for imports. Whoever is importing any quantity of goods and services from other countries, he is not supposed to take any license from government. Government has removed the licensing system for all types of imports. Okay, any entrepreneur can import any amount of goods and services from other countries wherever he required. So that facility, that freedom is given to all entrepreneurs in the Trade and Investment Policy Reforms 1991. Coming to the fourth aim of trade policy reforms, that is quantitative restrictions on manufactured consumer goods, also removed from April 2001. It is very interesting. Earlier in 1991 and before 1991 and after independence, there was a quantitative restrictions on manufactured consumer goods. There were many restrictions. Those restrictions were removed immediately after 1991 from April 2001, for example. This implication has been taken place in India, and all consumers can purchase any type of goods in the markets. They have given the free hand to purchase and get the maximum satisfaction by those goods and services, for example. Okay, so these are about the trade and investment policy reforms. Now look at one interesting question, that is currencies of different countries. Okay, it is very interesting question here, and this question may appear in the examination in project oriented question. In the section E, what I said in the earlier part in my first video lecture, when I dictated the question paper pattern, in that class I have explained about project oriented question. This is one amongst the project oriented questions. They may ask, write down the currencies of different countries and their name, with their name, for example, and sometimes they may ask the value of currency also. Here I have shown few countries' currencies with their values respectively. Look at the first one, that is USA. USA country's currency is dollar. The name of the currency is dollar, for example. To purchase $1, how much you have to pay? In Indian rupee terms, we have to pay 74 rupees 46 paise. The value of each US dollar at present is 74 rupees 46 paise per dollar. If we are purchasing $1 American, we have to pay 74 rupees. Okay. Look at the UK, United Kingdom's currency. The name of the UK currency is pound sterling, for example. Okay. Look at the value of the currency. UK pound sterling currency value is 96 rupees. To purchase 1 pound sterling, we need to pay how much? 96 rupees. Here you are able to understand the depreciation of the Indian rupee. Okay. If you are looking at US dollar currency value, for example, we have to pay 74 rupees, and for UK pound sterling we have to pay 96 rupees. So it means what? in UK market, the value of Indian rupee is very less compared to US dollar market, for example. Okay. Now coming to the Japan yen. Japanese name of the currency is yen, for example. Here, Japanese currency value, if you are looking at that value, Japanese 1.41 yen is equal to India's 1 rupee. Okay. We can purchase 1.41 Japanese yen by paying 1 rupee. Okay, it means what? Here in Japan, India's currency value is appreciated. In case of Japan, India's currency value is appreciated, and in case of UK and US, for example, currencies, India's, for example, India's currency value is depreciated. Look at the China. China's currency is, name of the currency of China is yuan. Look at the present status of yuan currency value compared to Indian rupees. To purchase 1 yuan currency of China, we need to pay 11.13 rupees. Okay, it is the value at present. If you are purchasing 1 yuan of China, we need to pay 11 rupees 13 paise. Okay, now look at the Korea. There are two, for example, currencies in Korea. One is North Korean currency and another one is South Korean currency. But the name of the currency in North Korea and South Korea is won, for example. But value is little bit different in case of North Korean currency and South Korean currency. To purchase 1 North Korean currency, we need to pay 15 rupees 24 paise. For 1 Indian rupee, we are able to purchase 15.24 North Korean currency, that is won, for example. Okay, so India's currency is appreciated in case of North Korea. Okay, it means what? For 1 Indian rupee, we are able to purchase 15 North Korean won, for example. Okay, coming to the South Korean currency, the name of the currency is, for example, same as North Korea, for example, here, that is won. North Korean currency value is little bit different in case of South Korean currency value is little bit different compared to North Korea, for example. Here, our Indian 1 rupee is equal to 12 North Korean currencies. Okay, that is won, for example. If we are paying 1 rupee, 1 Indian rupee, we are able to purchase 12 wons of South Korea supposed to be. Okay, so this is all about Korean currency. Now look at the Singapore. There is a small mistake in the word Singapore. Sorry for that. Singapore currency name is Singapore dollar. Okay. Singapore dollar is also very costly against Indian rupee. We need to pay 54 rupees, 54.5 rupees to purchase 1 Singapore dollar of Singapore. Now coming to the last one, Germany. The name of the Germany currency is euro. To purchase 1 euro currency of Germany, we need to pay 86 rupees 67 paise. Okay, I hope you understood. This is all about the currencies of different countries. They may ask the same question in the examination for 5 marks in project oriented question. Okay, with this we stop today's discussion. Remaining part we shall discuss in the next online class. Till then,